Hello learners, I am Dr. Nidhi Mathur and the subject expert is Dr. Neeti Mathur, teaching in National Law University, Jodhpur, Rajasthan. Today, we are going to talk about foreign exchange markets. Foreign exchange stands for the conversion of one country's currency into another, where the value of any currency is determined through the laws supply and demand. The foreign exchange market or the currency market is the place where the exchange of currency takes place. Foreign exchange market is an over-the-counter global marketplace that determines the currency's exchange rates, and participants of the market are able to buy, sell, exchange or speculate on various currencies in the world. Let us talk about the brief history of it. The barter system has been the oldest method of exchange that is known to be introduced by Mesopotamia in 6000 BC, where goods were exchanged for other goods according to their comparative value with each other. Eventually, in 6th century, gold coins were produced and used as a currency due to their characteristics such as portability, durability, divisibility, uniformity, limited supply and acceptability. Gold coins were widely accepted as a medium of exchange. However, due to its heaviness, it seemed a little impractical for large transactions. Eventually, in 1800s, many countries like Japan, Germany, France, USA, etc. agreed upon to the gold standard system. The paper money according to the value of gold was used for trading and assured that the participating countries would be able to fairly make trades and exchanges in accordance to the value of their paper money in terms of gold. During World War I and II, the gold standard system collapsed, leading towards the Bretton Woods system, which was an adjustable packed foreign exchange market in which the value of one currency was kept fixed in comparison to another currency, and other countries were fixing their exchange rate to US dollars, making dollar the reserve currency of the world. The system eventually failed as the circulation of US dollars massively increased and there wasn't enough gold to back it up. All these steps lead to the foreign exchange market towards free floating system, wherein the exchange rates are governed by the law of supply and demand purely. Understanding foreign exchange market. Foreign exchange market is by far the largest financial market of the world, and it comprises of global financial centers across the globe working 24 hours a day and closes only on weekends. Currencies are traded in pairs, for example, USD INR, USD Euro, USD Japanese currency, Euro, INR, etc. The value of one currency in a pair is relative to the value of other currency in that pair, and establishing this price-based relationship of currencies is the main function of foreign exchange market. According to the Bank of International Settlements, per day trading average of foreign exchange market for the current financial year is about $6.6 trillion. Some major characteristics of foreign exchange markets are: the huge trading volume leads to high liquidity and makes it the largest asset class in the world. The geographical dispersion, in addition to being the largest asset class in the world, contributes as another main characteristic. The market is open 24 hours a day, trading continuously except for weekends. There are various factors that affect the foreign exchange market, such as inflation rates, interest rates, terms of trade, political stability, economic performance, speculation, recession, etc. The market transparency helps traders make better trades and investment decisions, as they have access to all the market data and information, and they can monitor the exchange rate fluctuations through the real-time portfolio. The dynamic character of foreign exchange market makes it the perfect market to trade due to rapid price fluctuations in the exchange rate of currencies, changing in accordance with law of demand and supply. The trading cost in foreign exchange market is very low, and that enables small investors to make good profits by trading in foreign exchange with less capital. Let us now talk about the different types of foreign exchange markets. There are 5 types of major foreign exchange markets. Number 1, spot market. Number 2, forward market. Number 3, swaps market. Number 4, future market. Number 5, options market. Here, swaps, future and options are derivatives, as their value is derived from the underlying exchange rates. Spot market, the fastest currency transactions takes place in the spot market of foreign exchange, primarily in the form of buying and selling currencies. It provides immediate payment to buyers and sellers of a currency as per the current exchange rate. The trades take around 1 or 2 days to settle transactions, and it accounts for almost 1/3 of all currency exchange. There has been an increase in the volume of spot transactions in foreign exchange market, and as per the Bank of International Settlements, about 50% of all transactions in foreign exchange takes place in the spot market. Forward market. It is the market of foreign exchange that ensures the future delivery of a foreign currency at a specified exchange rate. The rate at which one currency can be exchanged for another currency in a specific future date is called as forward rate. The amount of a specific currency to be exchanged, its exchange rate and future delivery date are specified in an agreement which is called as a future contract. The forward rates are usually negotiated for the period of 1 month, 3 months or a year after the date of creation of the contract. Forward contracting is very useful in speculation and hedging. if a speculator has a knowledge and information of fluctuation in exchange rate based on the rise or fall of demand or supply of an asset, they can go long or short in the future contracts accordingly, either to hedge their portfolio positions or making profits from price fluctuations. Let us now talk about swaps market. The most common type of forward transaction in foreign exchange market is swaps. A swap is not a standardized contract and not traded through an exchange. In a swap, the investors of two different countries exchange their currencies, lending and borrowing simultaneously, and reverse the transaction on a future date, and it often requires a deposit to hold the position open until the transaction is completed. There are two types of swap transactions in swap market, namely currency swap and interest swap. Currency swap is an exchange of fixed currency rates of one country with the floating currency rate of the other country, while interest swap stands for exchange of floating interest rates with a fixed rate of interest. Future market. It works on the similar philosophy as forward market. The contracts in future market are made between buyers and sellers to do trade in future, and all payments and deliveries are done at a decided exchange rate, which is known as future rate. The future market solves various problems existing in forward market, as the contracts in future market are standardized and cannot be customized, and also the trading is centralized through stock exchange such as NSE, BSE, NYSE, KOSPI, etc. There is no counterparty risk is involved, as the exchange itself becomes the counterparty for both the sides and ensures the trade. Future markets are highly liquid in comparison to forward market, as large number of investors and traders can participate in a same trade, resulting in huge volumes and higher transactions. Options market. It is the market where buying and selling of options contract of an underlying currency takes place. The agreement between two parties to facilitate and potential transaction on the underlying asset or security at a preset price, referred to as strike price, prior to contract expiration date, is called as an option contract. There are two types of options: call options and put options. A call option gives a right to buy and put option gives a right to sell, and an option buyer has right to sell or purchase the underlying currency in the agreement at a future date and at agreed rate, but no obligation as such to do so. A call option can be bought as a leveraged bet on appreciation of the underlying currency, whereas put option can be bought as leveraged bet on the depreciation of an underlying currency. The major purpose of options is hedging portfolios and speculation also. Option contracts always costs only a fraction of the actual price of an underlying currency, and it gives leverage to the trader or investor to bet on a currency without purchasing the actual currency outright. What are the key role players of foreign exchange market? The major role players in the foreign exchange market are based upon the level of capitalization and sophistication, which includes technical research, discipline, money management techniques, etc. The key participants are central banks and major commercial banks, forex brokers and dealers, hedge funds and fund managers, speculators or retail traders, arbitrators, businesses and corporations, mutual funds, pension funds and insurance companies. We will discuss about the key role players in some detail in order to understand their position and impact in the foreign exchange market. Central banks and major commercial banks. Central banks are controlled by the government and they act as a predominant monetary authority which obeys individual economic policies and facilitates monetary policies and strategies for the government to protect their currency from the risk of manipulations in valuation. Majorly central banks of all countries participating in foreign exchange are officially involved in it. The major role is to control the fluctuations of their currency in range bound fashion and neutralize the speculative manipulation. Both central banks and major commercial banks have crucial roles to play in the foreign exchange market. Central banks are responsible for holding the foreign currency deposits, that is international reserves. One important role of commercial bank is to multiply the wealth of their stockholders by participating in foreign exchange through the means of hedging, arbitrage or a mixed strategy. Forex brokers and dealers. Forex dealers are amongst the biggest and the most significant participants in the forex market, and they are also called as broker dealers. Dealers include both banking and non-banking financial institutions. They provide bid-ask quotes all the time for specific currency pairs they specialize in. If not all of them, there are a lot of dealers and brokers who uses their own capital to trade foreign exchange markets. Most of the broker dealers in foreign exchange market have huge transactions and trading turnovers, which provides the basic infrastructure for the common individual investors to invest and make profits in the interbank market. Forex dealers act as a market maker for retail traders. Hedge funds and fund managers. Big international businesses and international commercial banks have financial activities happening in multiple countries and currencies. Thus, they have a lot of foreign currency as asset or liability. So, the fluctuations in foreign currency may cause losses, and the fund manager's role is to protect the investors and their clients' portfolio by taking counter positions in the market to balance the losses in case of depreciation of a foreign currency. Options contract are majorly used for hedging the actual position in the market. For example, if a trader is trading in USD INR currency pair and bought dollars to speculate and make better profits on appreciation of dollar in future. If in case dollar starts depreciating, the trader can take a put option contract for a logical strike price and make counter profits in order to balance the losses in the portfolio and stabilize position for long term. Speculators or retail traders. Retail traders are the ones with no actual requirement of a foreign exchange, but they trade currency pairs for their own account, risking their own capital in order to make profits from speculation. Speculators generally do not hold positions for a long time. Instead, they take short-term positions to make short-term profits out of fluctuations in valuation. The number of retail traders is huge and constantly growing with time. However, they still contribute as a small segment of players of foreign exchange market. if compared in terms of capital investment and transaction size. Arbitrageurs. Whenever there is a price discrepancy in the market, the arbitrager start buying in one place and start selling in another till the discrepancy disappears. In this way, they serve a very important purpose, ensuring that the market, which is huge and highly decentralized, functions efficiently and provides uniform price quotations. They take advantage of price discrepancy in the market and make profits. Businesses and corporations. Multinational companies and international businesses are always seeking for foreign exchange in order to pay for goods and services. They may often trade fairly small amounts compared to those of banks or speculators. However, they are capable enough of creating short-term impacts on market rates. They don't have the power to set or control prices, and they buy and sell foreign currencies following the prevailing exchange rates. These businesses and corporations may have different sizes, such as small importer exporter or a big company with multi-billion-dollar cash flow capabilities. Mutual funds, pension funds and insurance companies. Lately, various kinds of funds and institutional investors have started taking special interest in foreign exchange markets and have been playing an important role in financial markets in general. Pension funds, mutual funds, insurance companies, etc. have been actively involved as an investor in Forex, where fund managers mainly invest on behalf of the various clients in order to make profits and provide accountable growth to their portfolio. Let us now talk about the hierarchy of major participants. Arranging the major participants of foreign exchange in a hierarchy helps to understand their position in the market, and it creates a representation of overall foreign exchange market structure, which is as follows: central banks and major commercial banks, online retail forex broker dealers, that is broking services, medium and small size banks, market makers, retail ECNs, commercial companies, hedge funds, pension funds, mutual funds, etc. Retail traders. As we can see in the hierarchy, the central banks and major banks are the prominent players in the market. Some major banks to be named are HSBC, Citibank, RBS, Deutsche Bank, JP Morgan Chase, etc. These banks, along with central banks, are the determinants of foreign exchange rates. The medium and smaller banks come later in the hierarchy, making up interbank market. The participants of this market either trade directly or through electronic broking services, putting forex brokers and dealers as the second most important player of foreign exchange. Non-banking providers such as market makers, commercial businesses and companies, various types of funds all come below medium and small bank, and in the bottom layer are the retail traders of foreign exchange market. What are the investment objectives? Investors and traders in foreign exchange mainly have three concerns, that is, rate of return. The primary reason for investment is wealth building and portfolio growth. Thus, rate of return is always a major concern for investors, as they are foregoing the current consumption for future consumption, with the expectation of making more money in future over their investment amount. Risk involved. In most of the cases, the risk involved is directly proportional to the rate of return. Thus, the key concern is of trade-off between risk and return. Liquidity or convertibility. It basically means the speed at which the assets can be converted to cash, as businesses, companies and banks need to have high liquidity in order to clear large amount of claims and payouts if claimed or requested by their depositors. Need for foreign exchange for international companies. International companies and multinational firms need foreign exchange for various different reasons. The very basic need is facilitation of currency exchange and determining the rates for the exchange to enable global trading. Foreign currency is the backbone of international investments and global trading, which makes foreign exchange market the most important market segment for international companies to survive globally. Without foreign exchange market, it is impossible to determine the value of goods and services imported and exported by different countries to each other, and it will completely cripple the functioning of international companies relying upon overseas resources and talent. International companies always need a fairly large pool of foreign currencies as assets or liabilities for transaction purposes in order to save themselves from the market exposure. But maintaining a large pool of foreign currencies comes along with the exchange rate risk, currency risk or foreign exchange exposure. These exposures can have a severe effects on companies' profitability, cash flows and market value. Foreign exchange provides the investors with hedging techniques such as using currency options contracts, forward contracts, future contracts, currency swaps, currency overdrafts, government exchange guarantees, etc. in order to manage foreign currency related risk. In simple word, without foreign exchange markets, it is impossible for international companies to carry out global trade and investments at all. Role of technology in foreign exchange market. Technology has revolutionized mostly everything for humanity, and it has a noticeable impact and influence over the functioning and operations of foreign exchange market as well. Before the era of internet and online trading platforms, the past restrictions made it complicated for brokers to evaluate, account and react to any fluctuations in the exchange rate, as exchange rate gets affected due to multiple reasons and environments such as social, cultural, political and even natural, and volatility of this market is high. With the rise of wireless technologies and mobile services, it took the advancement of the entire market to a whole new level, as now it is possible for a trader to access foreign exchange from any place and any time, and it gave investors a chance to handle their dealings in real time without the need of going anywhere, saving time and enabling opportunities. Development of online trading platforms and mobile trading applications have encouraged more traders to participate and speculate in foreign exchange market, and there are plenty of online brokers and trading platforms to choose from based on their services, brokerage and reliability. It has also made the fundamental and technical analysis of exchange rates easier with the development of predefined indicators and tools. It guides traders to speculate better. So, that is all for today. Hope you have understood. We will meet in the next episode with a new topic to take understanding of international financial environment at a deeper level. Till then, take care. Goodbye.